What's up, everybody? Welcome to another episode of Focused Free Fit. It's your favorite business coach, Coach Frank. And today we have an amazing guest, Lane Kawaoka. And he is an interesting individual. And I can't wait to dive deep into what he's been doing. So, Lane, welcome to the podcast.
Hey, thanks for having me. Aloha, everybody.
Yeah, there we go. So what we'll do is I always start with asking everybody about, tell us a little bit about yourself. I'd like to talk about where you grew up and let's see, how that molded and impacted you. And then we'll kind of go from there because there's a lot I want to get into today. And I think that the listeners are going to benefit from a lot of what you're doing as well. So please feel free to share with us a little bit about yourself.
Okay. So currently we syndicate apartment buildings and we buy other private equity deals outside of real estate. Over $2 billion of deals, and I think 10,000 plus units. But it didn't always start off like that. My story kind of starts off, used to be a W-2 engineer. And, people always ask me, how did I get into that? And I'm like, well, I just, when I was in grade school or in intermediate school, I think I Googled like what made the highest salary without going to grad school or, getting a doctorate. And it's all those engineering degrees. So I happened to be good at math and science, I suppose. Wasn't horrible at it. So I became an engineer. And if you can kind of tell, I call this the linear path where you're kind of sleepwalking through life and just doing what your parents told you. My parents kind of taught us to, study hard, be frugal with our money, and we'll get a good job and just work at that job for 40, 50 years, investing in your Roth IRAs, all that normal stuff. But right after I graduated college in 2007, again, mindlessly saved my money to go buy a house in Seattle, Washington. And then I was working a construction engineering job at the time.
Were you civil engineer?
I was industrial.
Industrial.
That was my undergrad, and I was never really like a design person, right? Like those are actually your good students. I was horrible at that stuff. Like people who went to engineering school or did physics class, like that stupid problem where you have the spider web and the wind's blowing 5 kilonewtons to the east, and what's the degrees of the web. I could never figure out how to do that, to be honest. I was just kind of I don't know.
Engineering I went to school for engineering as well. In fact, where are you located at now?
I'm in Honolulu, Hawaii today.
Yeah. My roommate in college, I went to an engineering school. My roommate in college was from Oahu. And I'll tell you, when I got there and took my first couple of classes in engineering, I realized how smart I wasn't. I was just like, it's difficult. Anyway, Sorry to interrupt.
No, I had the same experience. Like I knew day one going in. Like I did AP English or AP. I didn't do AP English. I did AP Calculus and a few others. So I kind of went in, as supposed to be a bit of a review, but I was like, whoa, I got rocked, right? I mean, I went to University of Washington, which is a decent school, probably not the best out there, but it is pretty competitive. And I learned pretty quick, like, wow, these guys around me, they know their stuff, and I'm just gonna have to try and hang with these guys and just get the damn degree and moving on. But moving off into actually getting a real job, I was like, what do you do when you're not really super good academically? I think I had like a 3.01 GPA when it was all said and done. Well, you become a project manager, right?
Yep. There you go. Big bucks. Time for the big bucks.
Well, you don't need to know anything, right? And the project kind of moves itself in most cases. And I was fortunate enough to get a good job with a Fortune 50 company, and they kind of stuck me out in the field. And the bad part about this was I was traveling on 100% of the time for work. Granted, I didn't have kids, family at the time, so it was actually pretty good for me. And this kind of ties in with the real estate investing where, I bought this house to live in 2009. It took me a couple years to save 80 grand from my paycheck. And then I was like only home on Saturday because, it's 100% travel. I had to like come home on Friday night, leave Saturday afternoon. I was like, this is dumb. So I just started to rent it out, got an old property manager to rent it out. and I didn't know anything about rental real estate. But then I was like, wow, this is kind of cool. And for I think I was in my early 20s. It's like, wow, this is a lot of cool beer money right here. Like I think the rents were 2,200 and the mortgage was 1,600. I didn't know anything about rent to value ratios, 50% rule to expenses. I just thought I was making like 400, $500 every month. And that was kind of my big aha moment where I was like, wow, this is a cool thing, this rental real estate.
Yeah. That's interesting because usually I mean, I guess I find you fall into two camps. Either someone stumbles into real estate, like I would consider that, or something major takes place where they just have this, oh my gosh, this is what I need to do. I mean, you had that moment after you stumbled into it. So like for me, I read Rich Dad Poor Dad and it was like click. So it was like an eye-opening experience for me. But before that, I'd never, I couldn't have mentioned anything really about real estate. So on the investing side. So I just think it's interesting.
Yeah.
But
I mean, you kind of hit it on the head. There's like, I talk to a lot of people when you get into this alternative investing world. You know, my case is like, the younger guys who just kind of haphazardly fall into it, and maybe they've had a mentor. They kind of get on this early track, and a lot of their net worths are like 2-3 million by the time they're in their mid 40s. Guys like yourself who kind of find it in the midway point, reading that book or some other podcast out there is another entry point. What I find for most of the folks I work with, they are usually in their mid 40s. Their net worth has surpassed maybe 1.5 million net worth. So there's some breathing room there. It's like, maybe I should be doing something with it. I got all the bases covered. And the other third ingredient is like they have kids that are like 10 years old, 12 years old. So I mean, I'm kind of in the thick of it. I got a 3-year-old. I'm like, good God, how does any parent try anything like new or have any time to try anything new like real estate or investing? You
yeah,
just go to work and come back home and play with the kids,
yeah.
because that's all you can stomach at that time of your life.
Plus the risk
But
factor when you have a
yeah,
family, like you don't take as many risks.
yeah, and that's where I was at a huge advantage in my early 20s. I mean, I I just uprooted all my stuff, threw it in a storage room, and then, I went from saving like 30, 40 grand a year for my engineering job to saving 100 grand every year for I think like 4 or 5 years there. I didn't actually live anywhere. I lived on the company dime from hotels. So that really, if you just add that up, 400, 500 grand just plowing right to rental properties. But in reality, it was a lot more because the time value of money, right? The
Hmm.
first year, had the first rental, and then I think couple years later, I saved up to buy another duplex in Seattle, and that was around 2012. By 2015, I had started to buy properties outside my local area in Seattle because Seattle is a primary market. Really bad rent to value ratios. Pretty good for appreciation, but I'm not really an appreciation get lucky kind of guy. So I started to buy these turnkey rentals in Birmingham, Atlanta, Indianapolis, and I had 11 of them in 2015. But that was kind of where I hit an inflection point. With rental properties, they're great to get started, or what I call like in my new book, The Wealth Elevator. I call the first floor the wealth elevator, where you're not a credit investor and you're trying to get to that $1 million level. At that point, time becomes a little bit more important than money. That's where I was personally, traded in my rental properties for syndications and private placements and to get more diversification and certainly take my name off of the first line of, the guy being sued, right? Little rental properties are, a lot more liability. I would probably say 50, 100 times more liability than a portfolio of syndication deals as a passive investor.
Yeah, you're saying because if it's over 5 units, it's not coming back to you. It's a commercial loan, that type of stuff. It's not uh, recourse debt.
Well, yeah, I mean, I'm just talking about in terms of like slip, trips, and falls and frivolous
Oh, gotcha.
injury lawsuits.
Yeah,
But yeah, you're exactly right. When you're a syndication LP investor, you're not the person signing on the debt. Those are the loan guarantors and key principals, that are signing on the debt, on there. And yeah, when you're buying your own little rental properties, you're the person signing up for all that recourse debt.
Yeah. And it's I don't know if I want to go there yet, but I guess we could. We're talking about syndications. I want to get into a bunch of stuff here that you've talked, it looks like you've talked about. You have your books, which we'll talk about as well. Tell me though, before we get there, tell me how so you got this place in 2009, I think you said, right? 2009ish.
Yeah.
Okay. So you get a duplex. Is that what you said it was?
That was just a single family home. I mean, it
Single
was
family.
pretty
Okay.
a nice, cool place, right? Like
Yeah.
my early 20s. That's the stuff I buy. I'm an
Okay.
idiot.
Yeah. Well, hey, that's what you do what you do it. You don't really have a strategy at that point, probably. So, but when did you get to? So you were doing that for a while, and how did it go from onesie twosie to something more organized? And what made you? And how did you come up with that plan?
Yeah. So I mean, the first one was a single family home in Seattle, 2009. And then I saved my money to go buy a duplex in 2012. So if you kind of follow it, right, like it's
Okay.
taking freaking forever, right? Like I'm
Yeah.
limited to how much money I can save from my paycheck.
Yeah.
Even with me, living on the road and saving 100 grand every year, it was like slow, right? So for most people to, get to several units, it's going to take them almost a decade unless they
Yeah.
have a phenomenal salary over $250,000. But yeah, 2012, things got expensive in Seattle, right? The market started to pick up. And that was kind of where I started to buy properties out of state, in these more flyover, parts of the country. So I traded in those. I did a 1031, traded in those Seattle rentals, which I don't really think 1031s anybody should be doing those types of things. In reality, we can talk about that later. But I
That's
got.
interesting. I want to
I mean,
know. I want
I
to.
made all the mistakes.
Yeah, I definitely want to talk about
Yeah.
that. But go ahead.
So
Sorry.
so I traded in those and I had bought 11 out of state, in 2015.
Okay.
But that was kind of the point where I started to learn about syndications and private placements. More importantly, like, I think that the big thing for me, like up until that point, I was kind of just doing this all by myself. Wasn't talking to anybody. Yeah, sure, I was reading books and listening to podcasts, but after a while, you kind of heard it all. And it wasn't until like I kind of haphazardly ran across other accredited investors, right? People who had owned rental properties older than myself, and they were all shedding their rental properties and moving, you know, going into transformation from a little caterpillar to a accredited investor butterfly, and going into these syndicated deals, and for the liability, these deals were more value add, right? Because when I was just buying little rental properties, in reality, now looking back, I was just doing the buy, hope, and pray strategy. You get some good debt, you get some leverage on it. If you're not doing any major renovation to the unit, you're not doing a damn thing to bump the net operating income, and you're just buy, hope, and pray. You're just
Yeah.
praying that the market appreciation. And yeah, real estate typically it goes up, unless in 2022 and 2023 when you have a correction because of 40-year
that's
high
true.
interest rates.
Yeah,
But
long term it's going to, but nothing like what you would do if you bought a rundown property and added value to it and fixed it up.
right. But if you notice, I'm kind of lazy, right? And I had a good job. So there's a lot of investors out there that are accredited investors that just, quite frankly, it's just not worth the risk to dick around with all these renovations and the burst strategy. To me, the burst strategy is for broke guys.
Yeah.
If you're under $250,000 net worth, I get it. You got to do that type of stuff. But if you're a working professional, you already make $100,000 plus at your job, it might make more sense to, just get another promotion. And that was kind of the track that I was on. Sure, you may not like your day job, but certainly if you're a high paid professional or a doctor making $300,000, $400,000 a year, that's what you got to do. You got to kind of suck it up. But take all that money in the meantime for 5-6 years and plow it into real estate like how I did. And then you'll get choices.
Yep. So, okay. So you said to yourself, you were talking to these guys, they're accredited investors. What was your next move? And how did you get into it? Sounds like I don't know if this is what you've been doing since then, but it sounds like we're talking syndication, multifamily type stuff. So with GPLP, you're doing bigger deals. So did that start right off the bat? You said you bought your first duplex, I think you just said, after a couple single families. How did that escalate to kind of what you're doing today?
Yeah, I mean, I think what I do is I try I tried things on a small scale, and then I move swiftly, and I kind of go all in after that test run, right? Like when I bought
Interesting.
my
Gotcha.
first property in 2000, when I bought my first like remote rental in 2012 or 13 in Birmingham, I bought one. I was like, this works, right? I don't have to be
Yeah.
around. I don't need to touch it or see it.
Yeah.
Probably better I don't do that. I sold the Seattle rental properties and I went all in. And I bought 11 out of state, right? So no different.
Yeah.
I like the proof of concept idea, and then I move swiftly. So same thing here, invest, 50 grand as a limited partner, see how it works, see if it's the right fit for me, and then kind of sell everything else and move it all into that type of stuff
Yeah.
after was kind of what I did. But then, I kind of run into problems because when you're first starting out, I mean, at least speaking for myself, I didn't know any other accredited investors. My parents weren't wealthy. I
Yeah.
didn't have a rich uncle. I didn't have a community of other purely passive accredited investors, right? And like the local real estate club is like the worst place to go and network. Everybody's broke there, and they're just a bunch of wholesalers and flippers, guys who think real estate is a great way to get rich quick.
Yeah.
But the investors investing in these more country club deals are wealthy. They don't have time for, screwing around and going to some happy hour with some 30-year-olds.
Yeah.
And plus a lot of these deals aren't located in your local area. So it took me a while to kind of find the people doing these deals out there, and inevitably the people I find are the guys who are just good at marketing. And, I think the first 15 deals people I invested with, maybe a few of them turned out to be landmines. Just fake it to make it operators who had under quarter billion or 250 million, 500 million under assets of experience. So everybody's good at us building a social media presence out there. All these programs, I know them all. They all
Yeah.
teach you more about taking selfies and writing
Yeah.
internet copy than actually operating the damn investment. But that's just how it is.
Yeah.
Unfortunately for passive investors, when you don't have a network of purely passive accredited investors, that's the S show that you're going to be stuck with at that
Yeah.
point. Um, but I've lost money wrestling with the wrong people, but hey, that's part of the
It
game.
always happens.
Yeah,
You do enough deals, it happens.
yeah. And then I started to realize, see, man, these guys are a bunch of jokers, right? I mean, here I am as a professional engineer going back and forth with contractors, change orders, and just project management. A lot of these guys doing these deals are not, they don't have college degrees, which I don't think is that
Yeah.
important. Don't get me
Yeah.
wrong. But a lot of these guys haven't been working for a Fortune 500 company with a professional background. They're just a bunch of like glorified house flippers.
Yep.
And after being burned a couple of these times with a bunch of yo-yos in a suit, I was like, yeah, screw these guys. I'm gonna do this myself. I don't trust anybody. And that was kind of where we started to, do our own deals. We would start buying little 50 unit, 100 unit properties that are Class C. So
Hmm.
Class C are a little bit rougher properties where, some of these, I remember we had like 168 unit, like 80, only 80% of the people would actually pay. Right? Like, so 20% would be
Yeah.
deadbeats. But that's pretty typical, or not typical, but pretty can be expected for Class C properties, especially in the value add stages, right? Where you're kind of
Sure.
taking over the asset. And that was kind of where it's like, yeah, we made some good money doing that, but man, is it a real pain and kind of a headache? And especially when you're working with investors that are like, what's going on? Why are 20% of people paying?
Yeah.
It's like,
Yeah.
and then, I think on that one, we more than doubled in like 3 years. It's like, people are like, oh, okay. Um,
Yeah.
but yeah, we started to step up to larger assets, more Class B, which are a little bit nicer. But still, like, apparently people think that they can just go to some weekend guru conference and buy a 400 unit apartment complex. And I saw the writing on the wall on this, because this is like 2018, 2019. Like, we would go and bid on a property. Nothing is off market. That's total bull. Everything is on market. This is a very liquid market, commercial real estate above 150, 100 units. Everything's out there. Sure, it might be shown to a few groups, but nothing's off market. That's baloney. You so you start to realize, like a bunch of these like totally inexperienced guys were competing with us and just beating the prices up. And it's like, all right, we need to see the writing on the wall, and like salmon, we need to swim upstream, right? So we started to develop properties because that was kind of where we had the professional background and experience to kind of just do that. Because the thing is, like, in reality, it's not too hard to get a loan for a 200, 300 unit apartment complex. The harder loans is getting it for the construction side to build it from scratch. So in 2020, we started the development projects, where, just to add it to kind of the mix. It's pretty rare that we can find maybe 12, 20 acres of land out there
Yeah.
that's in the path of progress. So it's not like, apartments, 100, 200 unit apartment complexes or 300 unit apartment complexes are out there all the place, right? So it's pretty plentiful. Not as plentiful as like single family homes. That's like huge
Sure.
competition, obviously,
Yeah.
but that was kind of the genesis. Around 2020, we went over $1 billion of assets under ownership. Kind of took ourselves out of the business to some extent, started to hire better people that were actually property managers in the early parts of their career that knew a lot more than us, janky entrepreneurs.
Yeah.
And, that was kind of a little bit of the transition. But yeah, that's kind of been our path, the latest
So
trajectory.
you guys timed it about perfect there, going in like early before 2018, 2019. That's a good timing. We won't touch where we're at today with multifamily, but
Yeah.
I
Well,
would like to.
I'll talk about it. I'll be the first freaking
Well,
person to tell people, like, it's tough out there. In
it
2020, like, interest rates 40-year high, quickest time in history. Um, it brought commercial real estate down to 30% off the highs. And
well,
unfortunately, it's a great entry point for people now, but
yes. What
you
about
would have never known that would have happened, right?
no. I want to go to, before I ask my next question, I want to go backward just for a second. So let's say you got somebody out there, and there's a lot of people that are going to listen to this, they have a couple properties, right? They've been in the game. There's some people that haven't been in, they're not in at all. Some that have, but they haven't made the leap to multifamily. Okay. So there might be doing maybe a duplex, quad, whatever, but most it's single family, maybe Airbnb. So what would you recommend for them? How would they, there's a lot of places we're going to touch on today that might help them set up for the money, but it sounds like what I hear in your story is save, save, save. And I'm sure there was a lot of sacrifice on that road. You were shoveling money to the side. You had you were pulling in $600 a month from your place, but that's nothing compared to what you had to save. So what would your advice be for the people that are listening saying, gosh, how do I bridge that gap? Because
Yeah,
that's tough.
I would say it's like, first, it's like a self-awareness of where you're at. That's why I wrote the Wealth Elevator book, because in there's like a pull-out page where there's like a chart, and it basically says like which floor of the wealth elevator you are at, or what's your cattle grade, right? If you're some guy that only makes $50,000 a year at your day job, then yeah, you may have to keep flipping houses, wholesaling houses. But if you're somebody who's making a professional salary and ability to make more, your highest and best use, it might be at your day job, and you invest more passively on the side. And I'll highlight that word, highlighting highest and best use. So what is your hourly rate, right? If your hourly rate is more than a few $100 at something, you're probably a passive investor, right? Just to give you an extreme example. The problem is when you're starting to kind of be in that limbo land. But I would say, check out my book, and see what floor of the wealth elevator you are at, right? When I was in my 20s, I was in the first floor of the wealth elevator. My net worth was not quite, it wasn't quite $1 million yet.
When you were what age?
In my 20s.
20s, okay.
But as soon as I did, like investing in little rental properties, taking on that legal liability just didn't make any sense. And I think for me, like when I had 11 rental properties, I mean, yeah, I have my professional property management to deal with all my headaches, but at a few $100s, couple $100 of cash flow per property, that ain't nothing, right? That's
Mm-hmm.
like, 11 times 300, that's 3 grand per month of profit after expenses.
Yeah.
Look, I'm not going to complain about that, but
Yeah.
most of my clients need 10,000 plus to be set
Yeah.
at least. So you're going to need to multiply that 11 rentals by 3. But I'll tell you, with 11 rental properties, I was having maybe an eviction, you know, once or twice a year, and some kind of catastrophe that happened every quarter, like a flood in the basement or something like that, tree
Yeah.
fall on the house. And which is fine. I think it's, that's not that bad. You're working your day job and you're making some phone calls to your PM. But if you were to triple that, now you're talking about an eviction every other month, and that's what got me. One in every 3 evictions I had, like, turned out to be some type of, like, I mean, the sheriff shows up to the house, throws all the crap out on the street. I mean, I'm not
Yeah.
there to see this, but
Yeah.
I'm just like, I just get these pictures from the PM with, like, just the house is just in disarray. Tw- $10,000 to $30,000 of repairs for each of those. And
Mm-hmm.
again, like, 1/3 of the time, in my experience, I must have had almost a dozen of these type of experiences of evictions, and a few of them ended up with this. So that's my data set. If you haven't had this happen, I know what the comment thread is going to say. Everybody's like a YouTube comment wizard here. They say, you're buying properties in the worst of areas. Like, look, man, I'm trying to buy properties in, like, not C class areas, like more like B.
Mm-hmm.
This is just people and problems, and you're going to have this. Talk to me when you have 10 evictions. What's your run rate and your road to recovery after those 10 evictions? Guaranteed, well, whatever. I'm not going to say nothing's guaranteed, but more
Yeah.
than likely, probability wise, you're going to have 1 to 2 of these repair bills that's going to be 5, 20 grand. And you're going to be like, first, you're going to lose faith in humanity. Like, who lives like this? Who leaves like 50 dog poops before they
It's
leave?
crazy
Like,
stuff you
and then
see.
you're like, all right, where are these syndicated deals where I'm a passive investor that I don't sign on the debt myself, that somebody else
Yeah.
plays asset manager, has skin in the game, and has some carried interest to the end game? Okay, bring it on. And that's kind of where I was at.
So I hear what you're saying, and I agree with everything you said. There's going to be a big difference between somebody who is a passive investor, unless you're doing things differently. From my experience and limited knowledge of syndications, you're putting in money, you might double it in 5 years on a lot of times, or you might get a payout along the way, a small percentage. And so it's good for a lot of people that they don't want to put the time in. They're passive, but there's a big difference between what a GP gets and an LP gets, right? Obviously, because they put in the work, they run the project, they take the risk, everything. So talk to me about that. And what do you think about that?
Yeah, I mean, most time, I'll just speak maybe generally, right? Like, I mean,
Yeah.
there's a sliding scale with this. Your newer operators under $1 billion of assets under ownership, you're going to have a little bit better fee structure and split structure. These guys are kind of desperate to get going, looking for investors. Maybe you might get, like an 80-20 split, where that's on the profits generally. And of course, there's a few ways that you've seen people do these things, more complicated waterfalls, but essentially it's like, of the profits, say a building is bought for 12 million and sold for 18, and there's 4 million, what is that? 4
Six
million,
gap,
6
6
million. Yeah,
million.
$6 million of
Yeah.
profits. Probably should have picked a better example. This is kind of difficult math for me in the morning. But yeah, like 80% of those profits go to passive investors, 20% goes to the general partner in that
Mm-hmm.
case. But that's for a newer operator.
Mm-hmm.
On the other side of the spectrum, more institutional operators. These are the guys with, billions of assets under ownership. First of all, as a passive investor, they don't want you. They only take check sizes of maybe $500,000, $1 million. This is like
Mm-hmm.
kind of where we try to collate our folks and get into these higher quality deals and get better
Gotcha.
economics and splits. But
Gotcha.
those split structures might even be like a 50-50 split. you're not going to double your money in 5 years with these guys. Normally it's like double your money in 10, but
Yeah.
it's very stable. You don't have to worry about like shyster operators getting
Yeah.
started.
Peace of mind.
I would probably call us somewhere in the middle, right? Like we like to get to know our investors to some extent. We have events, and I like that family atmosphere, but we're not the new guys
Sure.
anymore. Um,
Yeah.
in this world, I would say like 70-30 splits are kind of the normal or the standard.
Gotcha.
So, but at the end of the day, you're still trying to hit that 2x equity multiple by the end of the business plan. Developments can get there a little bit faster. That's the appeal for developments. But that's kind of where, I mean, to be transparent, like we were talking about the correction of 2020 to 23, right? When things go down 20 or 30%.
Yeah.
In reality, when you're in most of these value add plans where you're just essentially putting lipstick on a pig, yeah, it may be $10,000 of rehab per unit, new appliances, new paint job, new flooring, new HVAC, new chiller system, new playground equipment, enough to bump the rents up maybe 10-20% and add in other income across the property. Certainly enough to, on a pro forma double your money in 5 years. But all you're trying to do in that circumstance is bump the net operating income by 10-20%. That's enough to double your money. Why? Well, if we're using, people will use leverage, right? Number one. But that's the beauty of commercial properties. The commercial property is worth what the net operating income, which is income minus expenses, divided by the prevailing cap rate. So you have control over the income minus expenses. So if you can do things like renovate units and bump up the rents, that's how you bump up the NOI. And that's the business plan in most of these types of projects, 10-20% bump in NOI, which works, majority of the time. So in the last couple of decades, it's worked 90 something percent of the time. But when you have a correction year, when things go down 30%, even if you implemented the full business plan, you're SOL, you're underwater.
Yeah.
And this is kind of where, this is what's nice about development. Like we started development in 2020 in probably the worst of times in Lumbergeddon, like when lumber quadrupled in price, we had to put in extra money to pay for that. But we know that we're creating so much value. We're not just bumping up 10-20% net operating income. It's a lot more value add bump in this case. So, but we were able to, as interest rates started to creep up, actually not creep up, but initially they went up like half a point, three-fourths point, if I recall. I can remember where I was November of 2022. Well, everybody's butt was puckered up as these interest rates started to come up. We came out and were able to refinance out of our construction loan on that particular development deal. And the reason is because you created so much value from nothing. And, you were able to kind of just get out there in the nick of time in this interest rate environment as things start to get really, really bad at that point. But, we do both. I mean, we'll continue to do both strategies, right? Hit the ball where it comes, take the inside pitch, pull it, take the outside pitch, jack it to right field, right? Is kind of the idea. But that's kind of the issue with the light or the traditional value add play, where you're just kind of doing the 10-20% in lifts, which again, on a pro forma, it's enough to double your money in 5 years in a flat market.
Yeah.
But that's the little bit of exposure you have there.
So talk to me about a little bit, this is a little bit of a sidestep, but I'm interested to know, I think I saw somewhere you were talking about two things, infinite banking, I think, and 401k myths. So I'm just curious, because there's a lot of, unless I saw that wrong. So if I am, then just let me know. But I'm curious to know for the person that's out there, because a lot of people are thinking, okay, well, I'll do a self-directed, maybe, I don't know, or something like that if they are putting money in a 401k. So I was curious to see what your take was on it. And then also the infinite banking concept that I think a lot of people just don't know about. And I'm curious to know what your thoughts are on that.
Yeah, so I'll do the easier one first.
There's a lot to go over there, but just high level.
It's two separate topics here. So First, infinite banking is like a method that a lot of people will funnel their money through a whole life insurance first, put money in that, and then build up a cash value and take a loan from yourself, and then put it into a real estate deal or an investment or put it into the stock market. So it's sort of an intermediary step. And people are like, well, why are you doing this shenanigans, right? Why do this? Well, if you think of this whole life policy as sort of like it's an asset, right? It's a life insurance contract. It's not a hard asset, but it's actually like it's with these AAA rated companies, probably a lot safer than putting your money in your local bank in reality. So these life insurance contracts they're pretty solid. What you're doing is just like how people the way to think about it is, if you have a house, you you pay down your mortgage, you start to build up equity there. There's value there. Just like in a life insurance contract, there's the cash value portion. The HELOC, there's the equity portion. And how do you get the equity out of that? Well, you take the HELOC and you take it out and you go invest in other things. So this is no different than a HELOC on your house or rental property. And we're using it in the same manner. And I think this is gets thrown off a little bit, depending how people talk about this. But basically is you take your liquidity, you put it into this virtual house or this life insurance contract. You take loans from that, and then while you're doing that, well, just like that house who appreciates in value, even if you drained out the equity via HELOC, it continues to go up in value. Of course, real estate sometimes it doesn't, right? It's more variable, but this is where that's nice about putting it in a stable life insurance contract. It's more stable, just keeps going up. So this is where the idea, if you're making money in a couple places, another benefit is it's off the table of litigators. So if people recall how O.J. Simpson did all that stuff, I guess we can talk about him because he's dead now. Um, and I guess nobody cares about the controversy that all ensued. We're all over that apparently. But the guy had all his money in his 401k, and it's pretty protected against litigators. And your life insurance contract, especially if you live in certain states, is very similar concept to that. So the idea is you have a lot of your net worth kind of hidden here, and it's protected. But also you're getting a tax-free, usually about 4 or 5% normal ranges when the money is in there. And sure, you have to take a loan from yourself, but that should be taken as a business expense, right? In pursuit of other investments. So you got to talk to your own CPA, or if people want a referral, they can reach out. But it's pretty common that people will do this. And this, again, what I started to learn from a lot of these high net worth investors. But the key is like, and this is where things get, people get confused with this type of stuff, right? James Ramsey will like totally say like whole life insurance is a total scam. Well, the devil's in the details, right? It's all how the stuff is configured. If you're configuring it how most people will do infinite banking or whole life policies, the majority of it is the insurance portion. And that's where the commissions and the fees come out of. The way that, people in our world will structure it is either with a mere 30% or make it bare bones 10% insurance, so that you
They
minimize
overfund
those
it.
fees minimize those fees and commissions as much as possible. And then the other 90% or 70% can be those paid up additions, the overfunding thing that you're kind of referring to. So that's kind of infinite banking in a nutshell. I mean, I've got this it's kind of abstract. I get it, right? And it took me a long time to get this concept.
Well, when it's your first time hearing this, for anybody that's their first time, it's a lot right now. Check out your books or anybody else on infinite banking, because that would help.
Yeah. I mean, I've got this diagram. I think it's at thewealthelevator.com/bank. People want to check out. But to your next question, I put money in a retirement plan because that's what I was brainwashed to do, right? And that's what I did, right? And when I started to work, the Vanguard guy came to our office and he said, like, I think he came for free because he wanted to get assets under management for the company, and that was his job. But this is what we're all taught to do, right? To plow money into these retirement accounts and put it for the future, and to essentially create this big pile of money at the end. But if you think how flawed that is, right? Like you don't want to wait to the end. You want to you're at the end, you're gonna have to eat at this pile, right? Because you certainly don't want to eat the principal. You need to convert it to cash flow at the end. So why not begin with the end in mind and have all these mini streams of income, or mini pensions, or little rental properties, or little syndicated deals all over the place, and be able to eat from that pile of money, the streams. But for a lot of us, who haven't hit several $1 million net worth, for $4 to $5 million is what I define as end game for most of our clients. You're still in growth mode, and you should keep your day job, and you don't have to eat those streams of cash flow, and that streams of cash flow can make more cash flow babies for you. But that's esoterically kind of the high level. So let's dig into 401ks, Roth IRAs, or all these are called qualified retirement plan money, QRPs for short. So what I'm arguing here is, like, you need to fill up your cash flow to date bucket now, so you can eat that or choose to quit your job sooner rather than later. So there's kind of 4 big reasons why I would probably not put money into these qualified retirement plans. The first would be, well, you're going to have to pay taxes on this money at some point. Don't believe all the bull that people say, oh, it's tax free. You're going to have to pay the taxes at some point, either in the beginning, and then you take it to cash in and invest it, or at the end. The first argument is taxes are likely to go up, right? Like, I mean, look at all the government entitlement programs, whether you're Republican, Democrat, I don't care. Taxes are going to be going up. So in theory, it would make sense that let's take the tax hit now, and then so we're going to have to pay it later when it's higher, right? So that's the argument for not putting your money into one of these
Totally
qualified
agree.
retirement plans. Essentially, it's kind of a sneaky way for the government to have like a blank check to hit us up 10, 20 years, 30 years from now for whatever they want at the time. The second thing is, for you personally, most people in our world doing this stuff is going to make a heck of a lot more money in the future than it is today. Now, this might be opposite for the average American, right? Who's in their income generating years and make little bit to nothing when they're retiring, unless they greet people at Walmart. At that point, they're still not making that much money doing that. So that your tax brackets is more likely to be higher in the future. And of course, you combine what I've previously mentioned. So if you're kind of following me, the message is take the money out now, pay it at a lower tax rate today, then you would be in the higher tax bracket in the future. The third thing is, look, I don't know what the rules are, because I don't have any retirement plan money. I don't have any QRP money anymore personally, so I don't really follow the rules. But like, they keep moving the date back when you can actually use this damn money without penalties and stuff like that.
50, it's 59 and a half. You can start taking distributions. And I think it's either 65 or 67 and a half. You have to start taking distributions.
Whatever it is, it's too damn long, right?
Yeah,
like
if you're
doing this stuff for 5 to 10 years, you're going to start to see the light at the end of the tunnel.
Yeah.
And you're going to want to pull your money out of this sooner rather than later.
Yeah.
Right. You want optionality here. Again, for the average American, this stuff is good, right?
Yeah.
It also helps them keep their grubby hands off their money, which is the same concept for why I think most people should buy the house to live in, because it becomes a forced piggy bank.
Yes.
But for you and me listening and all the listeners, we're a little bit different than that. The fourth reason why, and I think this might be the biggest, when you invest cash into investments, especially real estate, you get the depreciation and losses, bonus losses, stuff like that. And you can use that to manipulate your taxes today. If you have RUP status, real estate professional status, you could possibly drive your income down to zero if you wanted to. Most times we usually say $200,000 for a married couple, or $380,000, because that's kind of the sweet spot. But even if you're not doing RUP status, you can use these losses to drive down your passive income to nothing. It's the RUP status.
A lot of people don't know about that one.
And this is the game changing thing, right? Like, this is where, like, most people are like playing checkers with their CPA in terms of like just deferring taxes, but then they get hit hard at the end. We're playing chess. We're driving our adjusted gross income down every year. I don't care what the headlines say that Biden's going to tax the wealthy. It's not the wealthy. It's the tax system is based off of what your adjusted gross income is. And if
Mhm.
you can legally drive your AGI down, you pay less taxes. And you pay less state taxes. Sorry for those of you guys who live in Hawaii and California too, because it's also derived off of that.
Yep.
But when you invest cash, you get these nice passive losses today to use that to drive your income down and to play these different strategies. But when you have your money in a qualified retirement plan money, sure, you can self-direct it. You can do a solo 401k. Those are a couple options to invest in alternative assets such as real estate, but it stays insulated in that qualified retirement plan. So those losses don't flow to you personally, and you can use it on your taxes today. And I think that's, we mentioned 4 things here. I think that's one of the biggest things, the biggest benefits, especially for higher income earners over $300,000 of income per year. But but it flies in the face of everything that we've been taught, right? And you have to be investing in things that make, give passive losses such as real estate for it to get all these benefits. But yeah, I think that's kind of why you have to surround yourself with the right people, right? And that's kind of why, the way we have a lot of free stuff on the website, and the book is out there, but we monetize a lot with like our paid mastermind groups and our events, because that's the hard thing, is finding a group of like-minded, accredited passive investors to crowdsource these types of strategies. Like, your CPA isn't going to give you this type of stuff. That's why he's still a bean counter working his job. The best piece of advice somebody gave it to me early on that guided me throughout is never take financial advice from people who's not financially free.
Mhm.
And that
Very good advice.
typically includes your certified financial planner, who just sells
Yeah,
you a bunch
absolutely.
of financial products, and your CPA, unfortunately.
We could go down this road for an hour.
Yeah,
It's
I
so
feel like
true.
I triggered you, Frank. Sorry.
Well, there's so many things I want to talk about, but I know we're tight on time today. So my thing is, I think there's so many important things that you said, but one of them being you're the sum of the closest 5 people around you. And I would actually tell everyone on here, which I've said many times, seek out a mastermind, whether it's yours or a mastermind of qualified individuals that are where you want to go and will support you. I think that's huge.
Yeah. I'll add on to that I mean, what's hard is like when it's just like 5 guys at the pub, a lot of you guys might be on the same level too, right? Like, and that's great, right? I think it's all good to have cheerleaders around us, but none of those 4 or 5 guys are going to have the answer right away. There's another side strategy where like they say, well, try and find a guy who's 5 years ahead of you, like kind of your mentor in a way, and then find a guy who's 5 years behind you, and then that guy also help you add value to you, and it's kind of this circuitous help everybody kind of a thing. But
yeah,
I think that's the hard thing. Everybody hears find the mastermind. It's just a lot of crap out there too, right?
there is. There totally is. There absolutely is, and I think it does matter. So where can everybody find you? Because I know we're coming to an end here. I could go on for a while. This has been a great conversation. Where can everybody find you? Where would you like them to go?
If they like podcasts, they can check out the Wealth Elevator podcasts. If you are short on time, just check out the new book, The Wealth Elevator, on Amazon. If you're an accredited investor and you're looking for a community, reach out, Lane, at the Wealth Elevator.
Awesome. Okay. Good topics. Man, we could go so much deeper on all of these. I appreciate it. And I hope that everybody checks you out. We'll put the links to all of that in the descriptions when we put this out. And I appreciate it. Thank you for your time today. I appreciate it, everybody. Thanks for being here. And we'll catch you on the next episode of Focused Free Fit. Take care, everybody. Bye.
Thanks.